If you're a small business owner in the UK, you know how important it is to manage your taxes effectively. Today, I'm going to walk you through a comprehensive tax saving plan tailored for your business. If you're running a business, this plan will help you to keep more of your hard-earned money and avoid those end-of-year tax surprises. Let's kick things off with the tax pot method. This approach is all about setting aside a percentage of your income into a separate account or a tax pot for different types of taxes. This ensures you're always prepared for those upcoming tax bills, and it helps you to manage your cash flow more effectively. Think of it as putting money in a separate jar for each tax type. It's straightforward, yet incredibly effective in keeping you organised. First up, self-assessment. As a business owner, you'll need to file a self-assessment tax return to report your personal income from the business. If your total tax bill is more than £1,000, you'll have to make what's known as payments on account towards the next year's tax. Payments on account are split into two instalments. You have one at the end of January on the 31st and one at the end of July on the 31st. Each payment is typically 50% of your previous year's tax bill, and it's meant to spread out your tax payments for you. To avoid any surprises, a good rule of thumb is to set aside 25 to 30% of your profits to cover both your self-assessment and your payments on account. Let's use Charlie as an example. So imagine they're builders with £250,000 turnover. After deducting business expenses, let's say Charlie's taxable income is £75,000. If their tax liability for the year is £18,750, they'll need to make two payments on account, each amounting to £9,375. Charlie should save this amount throughout the year to cover these payments, and that is £1,562.50 per month. By saving this aside, he's going to reduce his stress significantly. As a small business owner, you will normally pay both Class 2 and Class 4 national insurance contributions. So Class 2 is the flat rate and Class 4 is based on your profits. For Class 4 national insurance, set aside around 9 to 10% of your profits above the lower threshold. Class 2 national insurance are a flat rate of approximately £175 a year. These figures can change, so always do check out our tax tables for the latest up-to-date information. Charlie's profit is £100,000. They should save about £6,750 for Class 4 national insurance contributions, which is 9% of profits between the thresholds, and an additional £175 for Class 2 national insurance contributions, totalling around £6,925 for national insurance contributions, or £577.08 a month. Now, let's talk VAT. If your business turnover exceeds £85,000, you need to register for VAT. You charge VAT on your sales and you claim VAT on your business expenses. So for the majority of people through VAT is charged at 20% on your sales. So it's crucial that you're going to save this money separately as you go so that you can pay your VAT bill on time and not have a last minute rush, pulling pennies together because you thought it was your money to spend and not the taxman's money. This money was never yours. When you collect it on behalf of HMRC, please go and put it in your tax pot. It is separated from your income when you go on your profit and loss. So Charlie, with a £250,000 turnover, collects £50,000 in VAT, so 20% of its sales. So they should then keep this £50,000 in a separate VAT pot to ensure that they pay it across to HMRC when the VAT's due. If you then are able to reduce this with your expenses, fantastic. Reduce that amount and then put the difference back into your bank. But that money initially is not yours. If you employ staff, you need to manage PAYE and employers' national insurance contributions. So PAYE involves deducting income tax and employees' national insurance contributions from their wages and then paying it across to HMRC. So again, similar to VAT, you're just the middleman, you're collecting taxes and you're passing it along. With employers' national insurance contributions that are around 13.8% at the moment of your earnings, above the 9,100 threshold, this amount needs to be budgeted separately. So, taking you back to the example, Charlie's 2 employees earn 30,000 each, right? Charlie will deduct income tax and employee national insurance contributions through PAYE. For employer national insurance contributions, Charlie will need to set aside approximately £5,794 annually or £482.84 monthly. Running a limited company, you'll need to account for corporation tax, which is charged at 19% on your company's profits. Please do go and check out our tax tables because it does depend when you get to a certain amount. At the moment, it is on a sliding scale, so please do go and check that out. And also, this changes all the time. But save a portion of your profits each month as you go along to cover for the taxes. So doing this example based on Charlie's company, we'll do it based on 19%. So if they have profit of, say, £100,000, their corporation tax bill will be £19,000 because it's 19% of £100,000. So to cover this, Charlie needs to save about £1,583 every single month, and he needs to put that aside in a tax pot, call it corporation tax, and keep it there. Don't touch it. If you're working under the construction industry scheme, contractors will deduct tax directly from your payments and send it to HMRC. This is an advance towards your tax bill. Keep accurate records of these deductions to ensure your tax affairs are in order. So, Charlie's subcontractors might have 20% CIS deducted. If Charlie pays a subcontractor £2,000, they will deduct £400 for CIS. Very, very similar to payroll, CIS is for the construction industry and it's taking that money off the subcontractors and passing it along to HMRC early, just like anyone would be through payroll. Finally, let's cover P11D forms and benefits in kind. Now don't switch off. These are taxable benefits provided to you or your employees, such as company cars, right? And basically, you need to report these on what's known as a P11D form. Sounds super scary, but basically you need to be paying additional tax on these items that you're benefiting from. Charlie provides a company car valued at £5,000 as a benefit in kind. So they need to report this on what's known as a P11D form, and both Charlie and their employee might have additional tax to pay. So budgeting for these costs is absolutely crucial. By following this tax saving plan and using the tax pot method, you can ensure you're always prepared for tax season. Just like Charlie, planning ahead and saving consistently can make all of the difference. If you found this video useful, don't forget to like, subscribe and ring that little bell so you don't miss out on any future tips that may just help you in business. Thanks for watching and I will see you next time.